Hi, my name is Kevin Retcher, owner of First Meridian Mortgage. Today we're going to talk mortgage insurance. We're going to define it, we're going to dig into it, and we're going to get down and dirty with what everyone calls PMI, mortgage insurance. Nobody wants it, but when you need it and it allows you to get into a home sooner, it's a good thing. Okay, so majority of the time mortgage insurance is a positive. All right, so mortgage insurance is a safeguard for lenders. It ensures that they recover a portion of a loan balance if a borrower defaults. It is required on all loans if someone puts less than 20% down. It enables borrowers with smaller savings to access home ownership, reducing the risk for the lenders also. So keep in mind that anyone that doesn't put 20% down is going to have some type of mortgage insurance. And that's going to be determined on the program, whether it's FHA, VA, or conventional private mortgage insurance. VA actually has a funding fee, doesn't have monthly MI. FHA has an upfront fee and monthly MI, and then conventional only has just monthly or single premium or lender paid MI. MI itself bridges the gap between affordability and eligibility, allowing borrowers to purchase homes sooner instead of having to wait an extended period of time till they saved 20%. So let's get into some of the factors that influence the percentage of mortgage insurance required. So these factors include loan to value. Loan to value is the primary determinant of MI coverage requirements. If you don't put 20% down, you're going to have some type of insurance on that file. Higher loan to value loans generally require mortgage insurance coverage percentages at a higher level. 95 to 97 typically requires 35% coverage. 85 to 90 typically 25, and 80 to 85 typically about 12. Okay, loan terms. Loans that are greater than 20 years have a higher rate of insurance. Loans 20 years and less have a lower. So the amortization schedules are quicker on like a 15-year mortgage. So if you did have MI, it's going to drop really quick. Okay. Loan types, varying different loan types. Conventional financing, you can have single premium MI. You can have borrower paid MI, which is the most typical. And then you can have lender paid MI, which is more typical than single premium. Specific loan programs may have unique MI coverages. FHA requires an upfront mortgage insurance premium and a monthly. Conventional loans typically have three types of mortgage insurance. The most common is borrower paid. Then the second most common is lender paid. And then there's a single premium paid up front. VA loans have, instead, they have a funding fee, which the VA guarantees 25% of the risk for the veteran in lieu of MI. So there are different types of mortgage insurance out there. Factors that go into some of those, FHA is set, VA is set, and so credit score, credit history, and debt to income really only affect those conventional type of loans more often than not. Okay, lender investor requirements can be different between different lenders. They may have different MI coverage requirements for things like jumbo financing or ARMs in general. Okay. Fannie Freddie have specific guidelines for the loans that they purchase. They require certain amount of protection based upon loan to value and credit scores. Okay, some lenders have additional or modified requirements based upon their risk assessments. By considering most of these factors, the lenders and the mortgage insurers are going to determine the appropriate level of MI coverage for each loan, balancing that risk mitigation with affordability for the borrowers and risk assessment for the lender and or investor who might be buying the loan. Okay, so those are some of the factors that go into what your amount of the MI actually is going to be. Hi, my name is Kevin Retcher, owner of First Meridian Mortgage. In this episode of Understanding Mortgage Insurance, we're going to talk about exposure. Okay, so what in general does that mortgage insurance do for the lenders? Okay, so first and foremost, I want to start with Fannie Freddie as a whole. When we run a file through the automated underwriting engines, it's going to give us a percentage of exposure that the lender is willing to accept. Okay, so these are actual findings from a client, and here it says mortgage insurance coverage of 35% is essentially required. So in that instance, that's telling you how much exposure that the lender is wanting. Okay, so what does that mean when you talk about exposure? Okay, so if you look at this house here on a $400,000 property, if they put 10% down, right, and so they have $40,000 in equity, loan amount's $360,000. If that person defaults and they have 25% coverage, the lender can collect up to $90,000 in premiums on the insurance, which is $90,000 added to the 40. So their downside exposure is down to $270,000. So as long as they can sell that house with all their expenses for a greater number than that, they won't take a bath by making this loan. So that's one of the key factors of why mortgage insurance is needed. Someone's only putting 3, 4, 5, 10% down. If they walked away, lender would only have that $40,000 to deal with. They would definitely lose some money. So when you're looking at exposure, then within the brackets, just to take it a little bit further, Fannie Freddie might ask for only 25% coverage, or they might ask for 30% coverage, or they might ask for 18% coverage. All of those in general are going to then make the percentages on this right side of exposure to go less. So lower credit score or higher loan to value, you're going to need 35%. If you put 3 to 5% down, their exposure is down to 64% of the loan to value. Likewise, at 95, if you needed 35% coverage, along with your down payment, that coverage gives them exposure down, coverage down to 62%. So you can see how the mortgage insurance essentially allows the lender to lend with assurances that they're not going to lose money if you, in fact, walk away. The mortgage insurance is going to make them whole in most cases, unless the house was just left in really bad condition and the market itself has dropped value a lot. Okay, so this was your segment on exposure. So those different grids, that scale is going to go up and down based upon credit scoring and what the percentage of exposure that the lender's actually trying to protect themselves against. So let's get into the next section. So let's get into rate cards on MI. So we've talked about exposure, and we now understand a little bit of what that means, okay? So when it comes to FHA, FHA has standard mortgage insurance pricing based upon loan to value and not credit scoring, okay? So that DU findings, if it says 35% coverage, over here in the brackets, when it comes to mortgage insurance borrower paid, if you were doing 97% here and needed 35% coverage, you then find your rating or your factor in this column. If you need 25% coverage, it would be in this column, and if by chance you were able to do the 18, it would be in this column. You'll notice in the 95 and 97, they have 16 to 30, they have 18 to 35, 90, they have 12 to 25, and 85 and below, it's 6 to 12. A lot of this is based upon the fact that the MI is going to drop also, and it factors into giving the lender enough insurance to cover them until the loan gets down to 78%. So it will automatically drop here, all of these, based upon when the loan actually hits 78% on its principal balance, based upon the original appraised value or loan limits. I'll get into how you can cancel that MI later in the video. All right, so a couple key things here to think about. Remember, you have the 1 3/4 upfront mortgage insurance premium when it comes to any loans with FHA, and then you have the monthly accordingly, okay? So one of the exercises that you can do is, if you know what your credit score is and you're thinking about putting 10% down and you find out that your credit score is 740, you can factor out exactly that your mortgage insurance factor is going to be 0.38 at a max, okay? So you can just go online, print off these rate cards from a couple mortgage insurer companies. They're not hidden, they're publicized, and you can play around with what your mortgage insurance might be. You could actually figure it out yourself at home. Same for the FHA. If you go FHA, you add the 1.75% after you take off your down payment. It's based on the loan amount, 1.75%. You add that back on the loan, and it's that's how you finance it, okay? You are able to pay that upfront financing fee, the 1.75, in its totality. You can't pay a portion of it. So if you wanted to pay the full amount and not finance it into your loan, you can, but personally, 99% of the people out there are just going to finance it, okay? So let's get into how mortgage insurance is calculated on a monthly basis. Remember, we talked about the lender giving us a percentage of exposure that they're looking to protect themselves for, okay? So it could be 35, 25, or 10, and then we get the factor that goes into that number based upon the credit score. So if we had a $500,000 loan amount, and if it was an FHA deal, it's 0.55. You take 500,000 times 0.0055, add your two zeros into that, and then that equals $27.50 per year. Divide that by 12, and it's $229 per month. Likewise, I want to just run through another scenario. If it was a conventional and it had a factor of 0.46, 500,000 times 0.0046 would equal 2,300 divided by 12 would equal $191 per month. The reason here I used the FHA, anything above 95.01 would be at 0.55. So I just wanted to give you an example of the differences between that FHA and a conventional. So keep in mind, that is how the math is done. So if you were wanting to figure out how much mortgage insurance you might have, if you know what your credit score is, you could go to MGIC or Radian, find out what their factor sheet is. Just do the grid, find out what your factor would be, and plug it into the formula. So it's not that hard to actually figure out on your own how much your mortgage insurance might be. So let's get into some more extensive math, okay? So as I just said, standard FHA, 95.01 to 96.5 is 0.55 per month. Keep in mind the duration, that MI never drops off if you put down that amount of money, okay? Also keep in mind that standard FHA will have 1 3/4 upfront mortgage insurance premiums. So if your loan amount was $100K, 1.75%, that would be your base loan amount would be the $100K. Your actual financed amount would be $101,750. So in this example, 96.5% on 600,000, base loan amount would be $579 at 96.5%, times 1.75%, the MI that would be added to the base loan amount would be $10,132. So you would actually finance $589,132, even though your loan amount started at $579. You would be financing and rolling in this upfront mortgage insurance premium. Then on a monthly basis, you have to pay the 0.55 or the 0.5 also. Now on FHA, that MI stays on the loan for the life of the loan unless you put down 10%, then it drops off after 11 years, okay? And then, so if we're comparing these factors don't have a lot of brackets. So it's either 0.5 or 0.55. So if you have a lower credit score, FHA may be the better choice, okay? But let's look at a couple other factors here. If you move over to the conventional, if you put 3% down, your loan amount would be $582,000. You don't go backwards any, so principal and interest payment would be $36.78. That's using 6.5 as an interest rate on both loans. Over here, because of the MIP, you're actually putting more money down at 96.5 but your loan amount is actually $589 versus $582, so you went backwards over $7,000. So you actually have more equity putting 3% down versus putting 3.5% down. Okay, your payment over here would be $37.23 versus $36.78. Now, just to be fair, usually interest rates are a little bit lower on FHA because they're guaranteed from the FHA, and versus the mortgage insurance itself. Also gives a guarantee, but it's not looked as favorable. MI is still MI, but in FHA is just better priced because of the government pricing. Now, depending on the exposure, remember we talked about exposure, could be 35% or 25% at these levels. So it's based upon whether or not you can qualify for the lower mortgage insurance on the Home Possible Home Ready, which is Fannie Freddie's way of helping homeowners. So the factor here would be either 0.58 with a 760 score or 0.46. So in theory, that's very close and similar to the factor that you would have on FHA. Okay, so if comparing 760 on FHA and 760 on conventional, you'd be better off to go conventional because of the fact that the mortgage insurance will eventually drop when it hits 78%. This will never drop. You also don't have to pay the 1 3/4 premium here. So I'm even okay with higher monthly MI if I don't have to pay the 1 3/4%. Now, if we're looking further down the line at 719 as a credit score, everything else on the FHA is going to stay the same, but here on the conventional, your mortgage insurance premiums are going to go up compared to what they would on the FHA. So there'd be $110 cheaper if you had the 0.79 factor, and if you were at the 0.99, it'd be $210 a month difference there. So here you have to figure out how long you might have this loan to determine whether or not FHA would be better or not. Keep in mind you're still saving the 1 3/4%. So you're still $7,000 to the good here. So you can take 7,000 divided by 210, and that's going to be 3-4 years. So if you have the ability to raise your credit score and refinance and improve this MI number, you're still probably better off to do conventional. Okay. Let's say you have a 630 credit score. At that point, if you had a 630 credit score, I absolutely would default to FHA, because in the end, this number at 270 is going to versus 762 or $902 difference in MI, you're going to chew up that $7,000 differential in less than 12 months. Okay, so at 95%, it starts to get a little more swayed to conventional, because remember that these still drop. They're not for the life of the loan. You're not going backwards on the MI, and even with the lower score at 565 a month versus 241, I'm still going to go conventional most likely. Okay. With 10% down, it starts to get a little bit closer when it comes to the MI. In a worst case scenario, you're within $100, right? Both will drop off, but you still have the upfront. So if you think that you're going to be able to raise your credit within a year or two time frame, you're probably better off to go conventional. But if you need cash flow short term, then FHA might be the way to go. Okay, so these are some differences. Keep in mind, as your credit score goes down, then the likelihood of FHA being better is higher. Okay, so let's get into the next part of the equation. Let's talk strategy with MI. Okay, in many cases, clients may be liquidating assets to fund a down payment, and going all the way to 20% in some cases may cause a larger tax hit in 1 year. And in some cases, if you were to put 10% down this year and then refinanced the following year, liquidated some to next year, you could actually potentially save some money depending on if it kicks you into a higher tax bracket by liquidating. Okay, so you want to look at tax strategies and also potentially using the MI short term to potentially save yourself some money. The other strategy is also potentially when you go to do a refinance and you get to use that new appraised value. If homes are continuing to appreciate, you might be able to still have your money working in the market while getting out of mortgage insurance 6 months or a year later. Okay. There is also recasting of a mortgage. If you were to liquidate later, if you didn't want to do a refinance, you could apply and have your loan recasted or re-amortized based upon the new amount. Now, generally that doesn't get you out of mortgage insurance right away. You would then have to probably apply, and you'll want to listen to the tail end of mortgage cancellation of this video to see how that may be affected. How can MI be used to your advantage? Let's get into some examples. If you go to MGIC's website, they have under some basic training at MGIC, MI Basics. Highly recommend you work your way through understanding the mortgage insurance through the eyes of one of the mortgage insurers. Okay, so some of the examples that they have in their flyers: helping your borrowers buy sooner and earn equity with lower down payments. Okay, so it takes you through a college grad's example. He's got $8,000 left after college, and he's able to put 3% down and buy a home. It goes on to make some calculations. Whether or not you believe all the numbers or not, that's up to you. But in 7 years, it's indicating he's $51,000 better off. Okay. Example 2 would be, show borrowers putting down less can be more. I firmly believe in this one. And in this example, person's putting down 15% versus 20. But I highly recommend in many cases borrowers just putting down 10%. The mortgage insurance is not that much. And it's not uncommon that in that first refi, sometimes as soon as a year later or 2 years later, I'm able to refinance them to a lower rate and get them out of mortgage insurance. So if holding back 10%, 5% helps you to, one, get in the home, that's great. Two, if you have improvements that you need to make. Three, if you have investments that are quite frankly making better money than the MI. In many cases, like I said, if I get you out of mortgage insurance a year or two later, you probably didn't pay that much in mortgage insurance in reality if you have good credit. Other example, how borrowers can use MI to buy the dream home. In this example, 5% down was $18,000 versus waiting for them to have $75,000. The difference in saving up that additional money could be 7 to 10 years in some instances. So that's really why they kind of go into that time frame difference. MI can be used to overcome a low appraisal. You still want to buy a house, comes in lower, can't negotiate a lower price with the seller. Lender lends on the appraised value. So by adding MI, lender does the loan with 15% down versus 20% down. So in a lot of cases with clients that are waiving appraisals, which I'm not a fan of, it can, if they were going to put 20% down, MI could be a 10% buffer, which might make them comfortable in waiving an appraisal to win a house. Okay, so if it's your dream home, absolutely. Show borrowers how to get maximum value with a minimum down payment. So in some instances, right, FHA is 3.5% down, and conventional could be 97% down. So you might be able to buy more home with a conventional product, which has lower MI, if in fact you have really good credit, and it doesn't have an upfront mortgage insurance premium. Now, conversely, if you have low credit, then an FHA might be substantially cheaper than a conventional. So it's really going to depend on the grid of where your credit score is. The lower the score is on this side, the higher the mortgage insurance is going to be. Higher the credit score is, lower the mortgage insurance is going to be. Okay, so these are some key ideas on how mortgage insurance in itself is not a bad thing. You do not have to put 20% down to be able to qualify to buy a house. And then there's strategies on how to go ahead and cancel that mortgage insurance. Even if you never touch the loan, eventually that mortgage insurance is going to drop off by law. Okay, so next part of this video is going to get into how to cancel mortgage insurance. So again, my name is Kevin Retcher, owner of First Meridian Mortgage. I'm licensed in Virginia, Maryland, and D.C. My phone number is 703-799-5626. I look forward to serving you. To all the Marines out there, you know what I'm going to say? Semper Fi. I'll talk to you soon. Hi, my name is Kevin Retcher, owner of First Meridian Mortgage. Today, we're going to talk cancellation of mortgage insurance. Let's get into the long-term benefits in cancellation. Cancellation methods for conventional financing. Borrowers can request a cancellation when they get to 80% loan to value with a good payment history, and so long as there hasn't been a major reduction in values in the recent 12 months to 24 months. There's also an automatic cancellation when it gets to 78% per the Homeowners Protection Act. Here's the thing. When you think that and that is depending on your original appraised value or purchase price, okay? Whichever's less. So when it gets to 78%, it'll automatically drop. When you think you're at 80% on the amortization schedule, you can ask them, the lender, to go ahead and remove it at that point. And they might do that. They may ask for an appraisal just to get a current value, but you can request it when it's at 80. Here's the thing, there's a second rule of which you can do based on value. So let's say homes are appreciating and you've paid down, maybe you've made some extra payments. You can go through the process of potentially getting an appraisal, and the lender will typically look at a few factors: your payment history, recent values in the area. They'll also potentially look at the time that you've spent paying the MI. Typically, after 2 years, but less than 5, they might want a 75% loan to value instead of 80 to remove the MI. So if it's less than 2 years, they probably want the 75% also. If you've paid for MI for over 5 years, they'll absolutely most likely go to the 80. As long as you're at 80 on the value, they'll most likely drop it at that point. The other most common asked question is FHA. Can my mortgage insurance drop if I have an FHA loan? Loans originated prior to June 3rd of 2013 go similar to the conventional rule that is at the 78% loan to value, it will drop. During the mortgage crisis, the FHA pool of reserves was lower. They changed the rule June 3rd, 2013. Loans originated after that the monthly mortgage insurance is on the loan for the life of the loan unless you put 10% down or more. So that was to bolster the FHA reserves. Technically, the reserves are plentiful at this point, and there's actually a bill being proposed currently by Representative Meeks and Pete Sessions that would potentially allow FHA to cancel when it hits 78%, similar to the conventional rules that we go by. I feel that this will probably get passed. I just don't know if it'll be signed by Biden at the end of before he leaves, or if it'll have to wait for the next Congress. The main purpose behind this is, to be more fair, and people that do FHA typically are disproportionately impacted. They're typically lower income homes or minority borrowers. So I do feel that this most likely will get passed, and I feel it's a really good thing. Okay. Homeowners can also, in both FHA and conventional loans, get out of mortgage insurance by refinancing or lowering the amount of MI that they're paying. So one of the biggest things I've done over my 28-year career is mastered no-cost refis for people. So remember how I told you that conventional is based upon the purchase price or appraised value when the loans originated. So if you can do a no-cost refi, even 6 months after you've purchased, lower your interest rate and potentially lower a bracket or two on the MI. Maybe you put 3% down and now you're at 90% or 88% or 85%. You can lower the cost of that MI, okay? Likewise with FHA, you might be able to move from FHA into a conventional with lower MI. Especially like if you took the FHA initially because your credit score might have been dinged, but now that you're making payments on a mortgage, your credit score goes up, then you can potentially go into the conventional and have a lower rate of MI or get out of MI in its totality. So the no-cost refi can lower the threshold to get you closer to the 78% quicker. Okay, so one of the most common questions really is, how do I get out of that mortgage insurance? And you can do it kind of three different ways: refi, automatic, or request. All of them have their benefits to saving you long-term money. In closing, MI is a good thing. It gets people in homes quicker. It can keep assets working for you. It allows safeguards for investors and lowers their exposure. It can keep your money working for you. It can help you in a situation where your appraisal comes in low. MI is a good thing. The most important thing is to try to get out of the MI as quickly as possible and know what your options are. So if you have any questions what those options are, give me a call. My name is Kevin Retcher. I'm the owner of First Meridian Mortgage. I'm a veteran-owned business doing business in Virginia, Maryland, and D.C. I have 32 other states covered with broker owners that I've vetted. So if you need help in other states, give me a call. My phone number is 703-799-5626. As always, I'm happy to serve you. To all the Marines out there, I say Semper Fi. I'll talk to you soon.